Welcome to Live from the Compound. My name is Michael Bannock. I'm here with Barry Ritholtz and Dan Rasmussen, founder of Verdad Capital. Dan is well known for talking about all things private equity, and today we're going to use a paper he wrote in 2018 as a jumping off point. And the three topics we're going to specifically cover are why experts believe that PE firms make money by improving the companies that they buy, why experts believe that PE is less volatile and less risky than public equity, and finally, why experts believe that PE will significantly outperform every other investment opportunity. Dan, why do the experts believe this, and where might they be wrong?
Well, it's funny. I went to business school, and when I was there, I looked for a class about the private equity method, right? If these private equity managers are generating so much alpha by improving companies, I thought surely Stanford Business School will have a course explaining exactly how to do it. What's the recipe? What's the playbook? What are they doing? How do all these former investment bankers get so good at running companies? And I think that the answer is that there's no class at Stanford Business School, nor at Harvard Business School, because the whole thing is a mirage. Why do private equity firms take companies private? Why do they want 100% ownership? And what do they do after they buy the companies? I looked at 390 deals that issued public debt as part of the financing and asked exactly these questions. The answer is that revenue growth slows, margins improve.
Can I give you the numbers?
Yep,
because that's impressive that you had that off the top of your head. So in 54% of the transactions that you examined, revenue growth slowed 54% of the time. 45% of the time, margins contracted, and in 55% of the time, CapEx spending as percentage of sales declined. So if these are the facts, how come the story persists?
Well, it sounds very good. It's very appealing. Why else would they want to take control of the company? Why else do they sit on the board if not to improve it? It sells wonderfully. But the answer is actually much simpler. It's about increasing leverage, right? That's why you want ownership. That's why you want control, so you can change the capital structure.
But before the problems, this used to work really well. So what changed? Like this is not new. It's not like they just started doing this.
If you buy stuff cheap and it's levered and you get multiple expansion, you do really, really well. Mm-hmm. When you buy stuff expensive with debt and the multiple goes down, you get hurt really, really badly. And if you look at what happened with the private equity industry over many, many years, from about 1980 till 2006, private equity was purchasing companies at about a 40% discount to where the S&P 500 traded, right? So they could buy these small little companies cheap because nobody thought that private markets were a good place to be. They thought it's too risky. The companies are too small. We need to be in listed equities. It's not a real asset class. So they were able to buy them cheap. They were either able to roll them up or they were able to sell them to strategics at higher multiples.
So let me stop you right there. So going back 20, 30 years, the small private market, it's not especially efficient. It's fairly opaque. If you have an expertise in that area and you have some capital, the theory goes you could do really well under those circumstances.
There also wasn't a lot of fishermen. How many companies were there?
There were far, far fewer private equity firms back then. Right, and they were able to go and do these proprietary deals, the family business, buying family businesses, carve-outs of regional companies, right? I mean, it was a very fertile field. I mean, they were buying stuff at 4 or 5 times cash flow in the 80s and early 90s.
Mm-hmm. And today?
Today, it's over 12 times on adjusted EBITDA.
So I read not too long ago, and it might have been in something you've written, that in 2017, McKinsey observed that $750 billion new dollars were raised for private equity funds. That seems like an awful lot of money looking for a home.
Private equity is the asset allocator's asset of choice.
These days.
I recently ran a survey of institutional allocators, endowments, CIOs. 94% of them said that they thought that private equity would beat public market returns by 2% a year or more.
Wow.
What do you believe?
Well, I believe that it will underperform significantly relative to public markets. I believe it's one of the most dangerous, risky things you can invest in today.
Wow.
That's quite the statement.
That's the opposite of what a lot of people are saying.
It is.
And not only do they think that it's going to outperform, but they think that it's going to outperform by, how many people said 4%?
I think it was over 20% said over
24% said
yep.
by, in addition to expecting the outperformance, the expectation is that it's less risky and less volatile.
Yes.
I always hate the less volatile argument because my house isn't volatile because I don't get a daily or tick-by-tick print, but that doesn't mean the valuation doesn't swing around.
I actually like that argument.
We've discussed this.
I think that is to the investor's benefit. Obviously, it cuts both ways. We were just saying that
WeWork isn't volatile until it lost 90%.
Right.
But right up until that point, no volatility.
Take that out of the equation for a second.
Yes.
Don't you think that there, or maybe you don't think that, but is there a benefit to the fact that investors don't see the prices every single day?
There's costs and there are benefits. There are benefits in that they're less likely to panic and do a fire sale. The negative is you don't learn.
Meaning
Right?
what?
Okay, I had a private equity investor I was talking to who said, the thing I'm most proud of is I've never lost money on a deal. If you think that, does that mean you're a good investor? Right? It means that you are either delusional, lying, or, I don't understand how you could possibly think that or buying bonds, right? I mean, maybe you've been buying treasuries, right? But if you are buying micro-cap equities and think you've never lost money, right? What have you learned about investing? Not much, right? You never made a mistake, right? If I literally went into a job interview, damn, what's your biggest mistake? I've never made a mistake. And so why is private equity risky, right? I think that the volatility sort of lulls you into it. The returns have been so darn good for such a long period of time. David Swenson says it's a superior form of capitalism. He's the CIO of Yale. How could it possibly be true that all these smart people are wrong, right? 94% of institutional allocators think I'm wrong. Right, so 94% of smart people think that what I am saying, the smartest people who know the most about it think that what I'm saying is absolutely wrong.
So what are they missing? Why are you right?
Okay, very, very simple. They are missing the risk because they do not understand the credit quality of their investments. Okay, so I did another survey, same survey, I did another question. I said, what is your understanding of the credit quality of the underlying portfolio companies that your private equity portfolio are in your private equity portfolio?
That should be pretty straightforward to answer. Not a lot of subjective guessing there.
Okay. So at about 20, I don't have the exact numbers, but about 25% said that they believed that the companies in their portfolio were investment grade. 50% believed that it was double B. Rated. Double B bonds have a default rate of about 7%. And then, so that's a total of about 75%. And then the remainder thought it was single B or below. So about 75% said double B or above, 25% said single B or below. Okay, Moody's did a study. So think what you will about the credit ratings agencies. I think the criticism that's come at them is that they're too optimistic. They're in the pocket of Wall Street. Now, I think Moody's is great, by the way. That's another discussion. But their ratings of private equity funds. Okay, guess what percent of private equity deals they said are rated double B or above?
10%.
2%.
2%.
The answer...
So 98% B or worse.
B or worse, right. And that's of the bonds and the loans that are rated. There's a huge portion that's not rated. It's in the obscure parts of the private credit market.
And if it's not rated for a reason.
Right. And so what are the allocators missing? They do not understand the amount of leverage and the quality, the credit quality of the underlying portfolio. It's very evident that there's a complete misunderstanding.
So I know this is impossible to answer, but where and how does the rubber meet the road? Like, when are they going to wake up to what you think is evident?
And as a part of Mike's question, does this present a systemic risk, or is this just limited to private equity and a handful of giant endowments who will take a haircut?
Well, Josh Lerner from Harvard Business School has a great new paper about it. And Josh is the foremost, one of the foremost scholars in private equity. I think I would have accused him 5 years ago of being, sort of in the pocket of the private equity firms who were funding all of his research and was very pro-private equity. He came out with a big new study 2 or 3 weeks ago that was very anti-private equity, at least relative to stuff that he's previously written. And in that paper, he said that private equity, because of the leverage, adds to the pro-cyclicality of our economy.
Pro-cyclical as opposed to being counter-cyclical, which is how most people tend to think about private equity. Hey, the market drops, they get cheap pickings, they go out to buy stuff cheap.
But you're missing the dynamics of investing with leverage. Okay,
all
you
the leverage
cannot do
changes.
deals unless someone's willing to lend you money. Because private equity is LBOs, right? So if the lending stops, you don't do deals. That's what we saw in 08, 09. That's what we saw in January of 16. Deal volume is highly, highly correlated with lenders' willingness to lend as measured by, say, the high-yield credit spread.
So much for non-correlated to stock market.
But so hypothetically, if there isn't a recession and spreads don't blow out and things are fairly okay for the next 10 years, is it possible that you're wrong?
Well, it's always possible that I'm wrong. And let's add that. But let me keep going with this point. So pro-cyclicality and leverage, right? When you put the amount of leverage that's going on in these firms, right? When things go bad, these firms go bankrupt. And when they go bankrupt, they fire people. And that's what Lerner's paper said, right? So pro-cyclical employment is very, very bad. This hits Main Street in a way that, okay, the derivatives or something, how does that affect Main Street? I don't know. How does private equity stuff going KO hit Main Street? Through firings, mass firings. And that's what Lerner is saying in this paper.
How many people are employed in private equity-owned businesses?
They always brag about it, but I don't have the number off the top of my head. But a worrisomely large number.
The thing that I don't understand is that one of the reasons why they're so attractive to private markets is because they think public markets are richly valued.
Yes.
So if it's the case that that public market stocks are going to do worse, why would private companies do better? That I don't understand that part.
Right. So private companies are, I believe today, valued more richly than public companies. Right. So if you look at if you believe the pitch book numbers that it's 12 times adjusted EBITDA, you say, okay, adjusted's probably 30% below GAAP, 15 or 16 times EBITDA is the average price being paid for a private equity deal this year, right? S&P's trading at 12, right? So you're paying a premium to own private businesses. Now, even...
You're talking about trailing or forward?
Trailing.
Really?
You're paying more.
I think the S&P's higher than that, don't you?
It could be higher.
What was the number that you gave?
I said 12.
It's higher than that.
It's
I
higher.
think it's about 16.
16.
But still, private equity should not be trading for what public
Right.
equity
It's hard to pay more or equal.
illiquid.
You actually
not
wrote the
transparent.
average ratio of net debt to enterprise value at inception has been approximately 65% for PE deals, and the typical Russell small cap company was 16%. So that's quite a spread.
That's right. So if you're looking at leverage levels, and this is the crux of my argument, right, which is if you look at what PitchBook says on adjusted EBITDA, they're at 6 times net debt to EBITDA on leverage, right? Again, if you you say, okay, well, that adjusted EBITDA is BS, it's more like 8 times. Well, 6 times the line for triple C. So anything above 6 is triple C. So at least half of private equity is triple C.
All of what you're saying makes sense. I don't think like that this is a witch hunt by any means, but it seems like you are on somewhat of a crusade against private equity.
Well, I think it's the biggest correlated mistake that allocators are making today.
Correlated.
Yeah.
Really interesting. So there are 2 issues, I'm going to follow up Mike's question, that I'm kind of fascinated by, and I'm curious as to your thoughts on this. The first is, when we look at the world of hedge funds or venture capital, very fathead, long-tail distribution. Yes. Handful of giant winners, 11,000 also-rans chasing them. How is that distribution in private equity? Is it the same thing where there's a handful of big winners and then everybody else is chasing their tail trying to keep up with that
So
group?
it's a little different. So venture, you see a very small handful of firms generating very outsized returns with some level of consistency, okay? Mm-hmm. You know, Benchmark does a great fund. They do another great fund.
Blah, blah, blah.
Excel does a great fund. Persistence in private equity. So they do it in quartiles. So the first quartile fund, the chances that you raise a first quartile fund next time are around 25% these days, right? So there's no persistence. And so then the question is, okay, well, can you choose, right? Okay, you know, I understand that there are problems with private equity, but could I choose just the best 25%, right? Because if I got top quartile private equity returns, those returns would be great. Yeah. And there's a great study from the Oregon Public Employees Retirement Fund. It's one of the first investors in private equity. They started doing it in 1980. They've been doing it for 30 years. They've been advised by Cambridge Associates, all the best people. They recently did a study, and they said, what % of our funds have been top quartile, second quartile, third quartile, or fourth quartile? The answer is 18, 32, 32, and 18. Wow. So basically chance with a bit of a bell curve. Right. And you look at David Swenson, over the past decade, Yale's private equity results are 20 basis points better than the Cambridge Associates index. In other words, David Swenson hasn't generated alpha in private equity. Right. If David Swenson can't generate alpha in private equity, if Oregon can't generate in private equity, who can?
So you run a hedge fund. I know we can't talk specifics, but are you investing in these similar type of publicly traded companies?
So I think that if I look back at what worked in private equity, because it did work for a while, they were buying small, cheap, and levered companies. The average profile.
Small, cheap, and levered.
Yep. So it was always levered, right? But they were paying about 7 times EBITDA. They were putting about 4 turns of debt on it, which is still in the double B territory. Mm-hmm. And they were buying generally companies' market cap around $200 million. So I believe if you look at the historic returns of private equity, which are phenomenal, that's what they were doing to generate those returns. And the cheapest deals generate the most returns. Sure. So what I said is basically I think that in private markets today, you can't buy things at those prices. You haven't been able to buy things for those prices since 2005. Okay, that game is over. But if you look in public markets today, there are hundreds of companies that trade at less than 7 times EBITDA that have a reasonable degree of leverage and that are not going bankrupt.
So why aren't more people doing what you did?
I think that a lot of people, well, there are a whole variety of reasons, right? I mean, I think that everyone wants to do private equity. Everyone thinks private equity works. Why would you do anything different? And by the way, raising private equity money, I mean, that's great money.
Easy today.
It's high fees. People throw money at you to do it. It's a 10-year lockup. You don't have to report your results except for quarterly and based on what your accountants think it's worth. I mean, that's a great business.
Let me interrupt you right there about the results, because there have been a number of people who have raised the issue that the results as reported by private equity firms are wildly inflated. Do you have any insight or view on that?
I think they're inflated, but not wildly inflated. I think there are two issues, right? So issue number one, right, is that when public markets are volatile, private equity doesn't mark their...
Right.
So in Q4 of 18, S&P was down, say, 15%. I'm a little off.
20% peak to trough, just a hair under.
Private equity was down about 1.7, according to Cambridge Associates.
Right.
Alpha.
So either all the operational improvements they'd been planning all those years, they decided to implement of Q4 of 18, right? Or the marks are BS. And I think the answer is the marks are BS. But this is really important. So this is getting into like really deep stuff on why institutional allocators love private equity. But if you look at institutional allocators, so college endowments, the NACUBO survey.
Right.
In 1990, 55% of their portfolio is in public equity. Today, it's 55%. 1990, 35% was in bonds. Today, 15% was in bonds. Where did the money for their 20% private equity allocation come from? From bonds. And you know what? Private equity's reported volatility is lower than that of corporate fixed income. Okay? And so that's really important, right? Because if you think of the old game, the game that was smart, the game that worked in the 80s and early 90s was to say, hey, let's secretly switch out our bond portfolio for private equity. And it's going to be marked like corporate credit, and it's going to get equity plus returns. And so we are going to have the same vol profile as we used to 5 years ago, but better returns, and everybody's happy.
Do you think it was that pernicious?
No, I think that's how it's played out,
Right, okay.
right? People substituted private equity money for fixed income money.
Sure.
Andre Schleifer, who is the founder of behavioral economics, one of the most brilliant scholars, he says there are three ingredients to a financial panic or a fire sale: consensus, leverage, and illiquidity.
Mm-hmm.
Right?
You got all three.
You got all three. 94% agree. Leverage levels at all-time high, well above what the Fed said was dangerous, and you see increasing illiquidity, longer and longer hold periods.
I think this is a good place to leave it. Dan, thank you very much for coming in today.
My pleasure. Thank you
Fascinating
both.
stuff. Thanks for coming by.